Imagine this. You wake up one morning, check your crypto portfolio, and see a massive gain. You're ready to cash out, buy that dream car, or finally take that vacation. But then the taxman knocks on your door. Suddenly your gains don't look so shiny anymore. What if I told you that ignoring crypto regulations and taxes could cost you more than just money? It could cost you your freedom. Yes, you heard that right. Governments around the world are cracking down on crypto like never before. From the IRS in the US to the EU's MiCA regulations, the rules are changing fast. And if you're not prepared, you could be in for a nasty surprise. But don't worry, this isn't just another boring lecture about taxes. By the end of this video, you'll know exactly how to stay on the right side of the law, keep more of your hard-earned crypto, and sleep soundly at night. So, let's dive into the wild world of crypto regulations and taxes. Global regulatory trends. Let's start with the big picture. Crypto regulations are like weather patterns. They change depending on where you are in the world. Some countries are embracing crypto with open arms, while others are slamming the door shut. Take El Salvador, for example. They made Bitcoin legal tender in 2021. That's right. You can buy a cup of coffee with Bitcoin in El Salvador. But before you pack your bags, let's talk about the flip side. In China, crypto is basically public enemy number one. The government has banned crypto trading, mining, and even mentioning it in a positive light. And they're not alone. Countries like India and Turkey have also taken a hardline stance, with strict regulations and even outright bans. But it's not all doom and gloom. The European Union is leading the charge with its markets in crypto assets, MiCA regulation. This framework aims to create a unified set of rules for crypto across all EU member states. Think of it as a crypto rulebook that everyone has to follow. And then there's the United States. Oh, the land of the free and the home of confusing crypto regulations. The US has a patchwork of federal and state laws that can make your head spin. The SEC, CFTC, IRS, they all want a piece of the crypto pie. So what does this mean for you? Simple. If you're trading or holding crypto, you need to know the rules of the game. Ignorance isn't bliss. It's a one-way ticket to fines, penalties, and maybe even jail time. Tax implications. Now, let's talk about everyone's favorite topic. Taxes. Yes, I know, taxes are about as exciting as watching paint dry. But stick with me, because this is where things get juicy. First things first, crypto is taxable. Whether you're trading, mining, staking, or just hodling, the taxman wants his cut. And he's not messing around. In the US, the IRS treats crypto as property, not currency. That means every time you sell, trade, or use crypto to buy something, it's a taxable event. Even swapping one crypto for another can trigger a tax bill. And it's not just the US. In the UK, crypto is subject to capital gains tax. In Germany, if you hold your crypto for more than a year, your gains are tax-free. But if you sell before that, you're on the hook for taxes. Here's where it gets tricky, tracking your transactions. If you're trading on multiple platforms or using decentralized exchanges, keeping track of your gains and losses can feel like herding cats. But don't worry, there are tools like CoinTracker and Coinly that can make your life a whole lot easier. And let's not forget about mining and staking. Yes, even if you're earning crypto by validating transactions or running a node, that income is taxable. The IRS has made it clear. If you're making money from crypto, they want to know about it. Compliance tips. All right, now that we've covered the scary stuff, let's talk about how to stay compliant without losing your mind. Keep detailed records. This is non-negotiable. Every transaction, every trade, every tiny little move you make with your crypto needs to be documented. Use a spreadsheet or a crypto tax software to keep track of everything. Report everything. Yes, even that $10 you made from airdrops. The IRS and other tax authorities are cracking down on crypto, and they're getting better at tracking transactions. Don't give them a reason to come after you. Understand your country's rules. Crypto regulations vary wildly from country to country. Make sure you know the rules where you live and where you trade. Consult a professional. If you're dealing with large amounts of crypto or complex transactions, it's worth hiring a tax professional who specializes in crypto. Trust me, it's money well spent. Stay updated. The crypto world moves fast, and so do the regulations. Make it a habit to stay informed about changes in the law. Follow reputable news sources, join crypto communities, and don't be afraid to ask questions. Why this matters. Here's the bottom line. Crypto is no longer the Wild West. Governments are stepping in, and the rules are getting stricter. But that doesn't mean you have to panic. With the right knowledge and tools, you can navigate this new landscape like a pro. Remember, the goal isn't just to avoid trouble, it's to protect your wealth and your freedom. Because at the end of the day, crypto is about more than just money. It's about taking control of your financial future. So, whether you're a seasoned trader or a newbie just dipping your toes into the crypto waters, don't let regulations and taxes catch you off guard. Stay informed, stay compliant, and keep stacking those sats. Conclusion, and that's it. You're now armed with the knowledge you need to tackle crypto regulations and taxes head-on. But this isn't the end, it's just the beginning. The crypto world is constantly evolving, and so are the rules. So keep learning, keep adapting, and most importantly, keep thriving. Now go out there and make the Taxman proud. Or at least, don't give him a reason to come after you.